The syllabus, the normal information you'd see on there. Blah, blah, blah. You can look at it. As far as the coursework, somewhat important. Assignments and textbook problems are 20% of the exam, excuse me, of the grade. The exams are 80%. Oh, I know what I wanted to talk to you about before I did that. This is the Principles of Auto Insurances, second edition, McGraw-Hill. This is the book we're using, and this is a really good book. I think it's the best out there. So, and you can get any version of it you want. So if you want to do the PDF version or the loose leaf version or the online version, whatever, you do not need to have any of the electronic, connecting materials and all that. So any version of the book is fine. The reason I like this book, though, the author Whittington, one of the reasons I like it is Whittington he's the guy that writes the Wiley CPA review. It's the same person, and this book pretty much follows what you'll see on the CPA exam, especially like in the statistics chapter. A lot of these books, they have kind of wacky stuff for statistics, but it's virtually all comes right out of the CPA review, CPA exam. So anyway, I really like the book. It's a good book. It's not a cheap book, but you might be able to find it. I think this came out. I think the 22nd version came out a couple. You may be able to find it or used or rent it. Okay, let's get back to. Sorry, I've had tons of Benadryl. For some reason, my allergies are kicking up. So if I seem a little dopier than usual, that's why. All right, assignments. There's assigned for each chapter. Assignments are emailed to each student and are also available on Blackboard. The exams are only emailed because there's different versions of the exams. So the assignments will all be in Blackboard. Here, I'll show you where in Blackboard. You go to assignments and work. I'll probably go through this right now. And so here's where you would submit these. So when we complete these documents, you're going to submit them here. If you're looking for the documents, documents will be right with those. Everything except for the exams. The exams will, whatever one you got emailed, you turn that one in. I'm going to go over this for now, though. The assignments. Assignments are emailed or in Blackboard. Textbook problems are obviously in the textbooks. Exams are emailed to students. As far as completing those, you can write in the original documents. Type it in your computer or phone. You can scan the documents if you print out the documents, or if you do it on notebook paper, you can just scan that. Or if you do it on documents, you can take pictures of it, or if you do a notebook paper, you can take pictures of it. And you can upload as many pictures as possible. There's no limit on how much you can upload. So if you have 10 pages, you can submit 10 pages for the assignment. Things that are not allowed: zip files and page files. So don't zip the files together. If you take 10 pictures, it'd be reasonable to say, okay, let's zip those and put them into a page file. But Blackboard doesn't like those. So if you do take pictures, which is absolutely fine, you can just download all the pictures. Well, here, I'll show you. This is what the assignment looks like. Oh. Well, here's the name. Go down here, but you'll see that it's unlimited attempts, so you can put in 10 pictures if you want. That's fine. And the highest grade. So you can put in as many pictures as you want. Again, the only thing, don't put them into zip files and don't put them into page files. Well, normally that would be the way to go. Blackboard doesn't like it. Okay. Any question on that? Okay. So just close. All right, let's go back. Submitting work. We just did submitting work. Oh, this is important. Late work is accepted without penalty. So if you know, if you don't get this auditing review in by Friday, February 3rd, don't think you can't turn it in. You still can turn it in. Late work is accepted without penalty. Now, your grade's going to look bad until you turn it in, or it'll be lower until you turn it in, because it will, zero will be calculated in. But once you turn it in, you know, it'll go back to what it is. So don't think that because you miss a deadline, you know, a due date or whatever, that you can't turn it in. You can. And you can also turn in, except for the exams, you can turn in homework more than once. So if you turn in the homework and you did it wrong, or you did, whatever reason, you know, you turn it in, you didn't get the grade you wanted, homework and assignments, you can turn in again and I'll take the higher grade. The only thing you can't do that with is exams. Exams, you know, and you have a week to do the exam, so you should be okay with those anyways. But you can turn something in. So if you turn in some homework and you forgot a part or something, you get a 70, you can turn it back in and you get 100. Okay, now until you turn it back in, though, the 70 will be there. Okay. You get all these things popping up trying to help and they block what I'm doing. Okay, so late work is accepted without penalty. Here's if you're dropping the class or other classes. We already talked about this. There's our beloved grading scale. Okay, now I've updated the syllabus. So if you downloaded the syllabus, it's going to be a little bit different than what I'm showing you here. This is the updated one. I posted about a half hour ago. Everything else is the same, except I've changed around these down here a little bit. I've changed the kind of stuff we're going to go over. Okay, audit sampling. Audit sampling, there are 5 handouts for audit sampling. Or did I say that right? No, there's 4. I just lied to you. That's the first time I lied to you. You guys can write that down. The first time I lied to you this quarter or this semester. So the there's 4 handouts and an exam. We're going to do those during the semester. Now, some of you that have had me for the auditing 330, it's the same thing. So I think what I'm going to do is do those at the end of class, and that way, if you remember it enough, and you don't need to refresh or whatever, you think you can do the handouts on your own, you know, you can feel free to book out and you know, just do it on your own. So I'm going to do those near the in the last part of the class, just for convenience for people that have already had the class and already know how to do the sampling. And again, the sampling is very similar to what we have for the CPA exam. Okay. 1 second here. Okay. We have a little bit of a situation. Weeks 1, 3, and 4, we're going to be doing the chapter 10 handout and the auditing review, which we'll do today. Week 2, there's no class. And that's because I'm having hip surgery next week. So next Tuesday, I'm having hip surgery. And so we will not have class on week 2. So next week, no class. Week 3, we'll pick it back up and finish up the chapter 10 stuff. And hopefully have this send out the exam. So no class next week. But here's basically how we're going to run through these. And just so you know, this class is about the professional practice. In other words, actually doing the auditing. This class is supposed to be more practical, because you get all these, you remember the first auditing class is kind of theoretical. It's this, but not that, and all that kind of stuff. Whereas this is really the nuts and bolts of auditing. And quite honestly, this stuff it's on the CPA exam a lot, and it really hasn't changed. The actual way we do audits, even though there's theoretical stuff that comes into play, the actual steps of actually doing the audit really haven't changed that much. So the point being is that a lot of this stuff will be the same whether you take the CPA exam next year or 5 years from now. It'll be pretty much the same stuff. And it's all about how to actually do an audit, which is good. Okay. Yeah, you can go through that. Any questions on any of those? All right. Well, what I want to first start out with is this class kind of focuses on the CPA review, and it's focused on doing financial audits. And so one of the things I want to do is kind of show why we do financial audits in the first place. And how it's kind of a wacky profession. It really is. We'll get into a little bit here. Is there anyone that has not had an auditing class? Is this your first one? Usually there's some people that
this is my first.
Okay. All right. Yeah. And so we'll talk a little bit about why financial audits are really kind of wacky compared to other professions when they're doctors and lawyers and all that kind of stuff. Okay, these are the financial statements for IBM, and I guess it's a couple years old now. Actually, it's 1 year old. It takes me a little while to get them out, but anyway. So here's their income statement. Here's their balance sheet. Balance sheet accounts, blah blah blah. The rest of the balance sheet. Here's our statement of cash flows. All right, now, when IBM puts this out, so IBM makes these financial statements. So IBM created these. This income statement was made by IBM. This balance sheet was made by IBM. Statement of, still a balance sheet. Statement of cash flows, you guessed it, made by IBM. So how do we know that IBM isn't just making up numbers? How do we know that this is really their cash flow from financing activities? How do we know that? Well, an independent auditor comes in and looks at the financial statements. This is what CPAs do. If you get a CPA license, pass CPA exam, this is what it allows you to do. You're allowed to go in and audit a company's financial statements. No one else can do it. And the company makes their financial statements, and this report says whether they are good or not. Are these can you rely on these financial statements? So this report goes along with these financial statements, kind of to support and give credibility to the financial statements. Hey, somebody's gone in and looked at these financial statements, and they're giving an opinion about whether you can actually rely on these financial statements. And so let's look at the wording in this report, though. It's actually pretty interesting. By the way, the wording in this report is wording that you must follow if you are a CPA. In your classes, they always tell you don't plagiarize, don't plagiarize, don't plagiarize. If you're a CPA, you're required to plagiarize. If you don't, you can lose your license. So there are these boilerplate reports that they put out that you are required to use. only you can use them as a CPA, but you're required to use the report for, that's published for your, when you complete an audit. So these are, if you look at 10 different companies, they're going to have the same wording, virtually identical. I mean, they might have different years and all that kind of stuff, but okay. And so right up front, they tell their opinion. The financial statements above present fairly in all material respects. The financial position, which is just the same thing as a balance sheet. Say, why don't they say balance sheet? I don't know. They don't. Results of operations is the income statement. And it's cash flows, which is just cash flows for the period. Okay. And coming down here, we talk about, they'll also put in what their basis for the opinion is. And the second paragraph here has very important wording. Reasonable assurance. We do not give absolute assurance. We give reasonable assurance. And that the financial statements are free of material misstatement. Okay, so again, it's not absolute. And also notice that we're saying that the financial statements are free of material misstatement. So a couple things there. We don't give absolute assurance. We only give reasonable assurance. And we only look for the things that are material. For instance, $5 million, it depends. Well, is $5 million, a $5 million error, is that material? Anyone?
It would depend on the size of the company and how
Depends
much
on the
they're earning.
That's exactly right. Yeah, it depends on the size of the company. If it's Walmart, no, absolutely not. You're not going to be looking for $5 million errors if you're doing audit of Walmart. Smaller company, yeah, it might be, absolutely material if it's a smaller company. But so it really matters on what the size of it. So reasonable assurance, only material misstatements, and we're only giving an opinion on the financial statements. We are not giving an opinion on the company. So when we give this clean opinion to IBM, we're not saying, it's not a stamp of approval saying, hey, IBM is a good investment. All we're saying is the financial statements are free of material misstatement. Reasonable assurance that they're free of material misstatement. So we're not saying that it's a good investment. And even if the company's run very well, it still might not be a good investment. If the stock price, maybe the stock is worth $60 a share, but because of the market is trading at 80, well, that's still not a good investment. It's a good company. It might be overvalued or whatever it is. So we do not, it's only on the financial statements. We don't say whether the company is a good investment or not. Okay. It says we examine things on a test basis. We don't test everything. And blah, blah, blah. Okay. So anyway, so this is an audit report, and this is when you pass CPA exam, this is what you're allowed to write. You can't write this report unless you are a CPA. And you say, why is that? Why can't I write it too? It's because it's copyrighted. It's copyrighted material, and it's only CPAs are allowed to use it. Okay, so this is why we do audits, because IBM might be putting crazy stuff in here. How do we know their revenues were 73 billion? How do we know that? Well, we have the auditors go in, and independent auditors go in and check these things. Okay. Let's go to financial auditing review. This is kind of reviewing some stuff you had in your previous auditing classes. Now, if you haven't had an auditing class, this will be the first time you see it. But I'm just going to go through some of these different kind of definition-y things. Not too many of them. And then we'll talk a little bit more about the audit themselves. Okay. And by the way, any questions on that audit report thing? Okay, AICPA. The ACCPA is a club. With CPAs as members. You pass the CPA exam, the AICPA will send you a letter saying, hey, we got this club, and do you want to join it? So it's just a club of CPAs. The CPA makes rules for accounting. Oops. Rules for auditing. And the CPA exam. Okay, so AICPA, well, what do? They make the rules for accounting, make the rules for auditing, and they make the CPA exam. Now, the AICPA is just a club. So you may say, well, who cares? This club, it's like the Boy Scouts or the Girl Scouts or whatever. It's just a club. And they make these accounting rules, these auditing rules, and CPA exams. So you say, who cares? Well, governments will often use the AICPA guidelines to make their laws. And also the governmental agencies will say, look, you have to use, this club, you have to use their rules. So the AICPA themselves, they have no direct authority. They can't do anything. They can't take your license away, CPA license away. They can't force you to do anything. They can't do any of that. But government agencies can. And the government agencies say, okay, look, the companies that they have control over, they'll say, look, you have to follow that group's accounting rules or that group's auditing rules. And so it's kind of they have no direct authority, but they are very powerful just because they have this indirect authority that government agencies will oftentimes make use of their rules in that. They make the CPA exam. Every state uses it. The states don't have to use it. They could just decide they want to do something else, but the CPA exams made by the AICPA and it's created by the AICPA. What's on that? Okay, Financial Accounting Standard Board. The FASB. Makes accounting rules. And the accounting rules are generally accepted accounting standards. GAAP. The FASB, Financial Accounting Standard Board, is part of the AICPA. Auditing Standard Board. They make the auditing rules. Generally accepted auditing standards, also known as GAS. They are also part of the AICPA. CPA exam. The standard licensing exam used by all of the states to license CPAs. States do not have to use the AICPA's exam, but they do. All the states do use it. It's licensed by the they do use it for licensing. Okay, state boards of accountancy. Oops. The state boards are the only organizations that can issue CPA licenses. They're also the only board that can, the only group that can take it away. It's like a driver's license. And the CPA license allows for the auditing of financial statements. A driver's license allows you to drive. CPA license allows you to do audits of financial statements. No one else can do audits of financial statements. They can do audits of other things, but they can't do audits of financial statements. Any questions on that? So here's an important distinction, though. The states issue the licenses. The states are the only ones that can take it away. The AICPA cannot take the state licensing. It cannot take your license away. The federal government cannot take your license away. It's licensed by the state. Only the state can take it away. Yeah, so the actual exam itself, while it is made by the AICPA and is graded by the AICPA, the actual licensing comes from the state, not from the AICPA. Okay, issuers are publicly traded companies. Oops. Non-issues are privately held. Now, if they're privately held, there is no federal government oversight over these companies. So, and by issuers and non-issuers, this is kind of the terminology. They call people, public trade companies issuers, they call private companies non-issuers. Issuers mean they issue financial statements to the public, like IBM. Non-issuers, they don't. So the Securities and Exchange Commission is a very powerful commission. It's kind of like Big Daddy for business in the United States. However, they have no control over non-issuers. So if a non-issuer is making, their financial statements a way that the SEC doesn't like, doesn't matter. They have no jurisdiction over them. Well, the Company Accounting Oversight Board. I don't know why I put so many lines in here. The PCAOB, fairly new organization. I wish they came up with a better name for it. Oversees the audit of issuers only. They're non-issuers. If they're privately held, they have no jurisdiction. Okay, a couple of easy multiple choice questions. Which of the following organizations can license certified public accountants?
B. That's B, the state board
Yep.
counts.
And the next one goes right with it. What's the only organization they can revoke them?
B.
Yep, same thing. So these other places have no say over, even though they're powerful organizations in their own right, they don't have anything to do with the licensing. Okay, certified public accounting firms and financial audits. And so this is what that CPA license allows you to do that no one else can do. For instance, it's kind of like being a doctor or a lawyer. I can't practice law. I don't have a law degree. I haven't passed the bar exam. I'm not a doctor. I haven't passed the medical exam. I don't have the right to do those things. So the only thing that is, if you become a CPA, it's financial audits. It does not do anything else other than financial audits. For instance, almost anyone can do taxes. The CPA exam does not give you exclusive right to do taxes, but it does allow you to do financial audits that no one else can do. All right, this is the kind of the strangest thing about the profession. The CPA firm CPA firm and its employees must be independent from their audit clients. Their customers. Basically, their clients are their customers. Those are their customers that need audits of their financial statements. the CPA firm and its employees must be independent of their clients. Notice that this is way different. If someone was a doctor, you know, okay, your child falls down, skins their knee, you go, oh gee, you know, I'll help you, I'll put that. If you know, you don't say, oh well, we're, you know, oh, we're related, so I'm not independent, I can't put the Band-Aid on. But when it comes to auditing, you must be independent. You can't own, if I'm auditing IBM, I can't own any IBM stock, because then I wouldn't be independent. So you have to be independent, and that's kind of a weird thing, that you have to be independent from your client. You can't be an advocate for your client. You can't say, oh, you know, go to the bank for them and say, hey, you know, this is a really good client, you know, they'll pay their bills and you should give them a loan. You can't do that. You can't advocate for them. So a financial audit is very different. You're helping the client because they usually need an audit for financing or whatever it is. However, you're not there to advocate for them. You're not there generally to help them. You're not there to give them, you know, improve their product line or anything else. You're there to give them an independent audit report that people can rely on. And again, it says right on the report that it's independent. And it does that for a reason, so that people won't think there's a bias in it. Oh, I'll tell you one of the things. I noticed this the other day. When companies are doing their sustainability reports, which are really big in companies now, they can use a CPA firm to do it, but they can use other groups too. When you read the reports given by these other groups, they're hilarious, because they'll say things like, oh, you know, IBM has a simply fantastic organization for collecting data. And you don't find that kind of almost like advertising, you know, testimonial stuff in audit reports. You know, we're independent. You know, these other places you can tell are not. They're advocating for their, you know, whoever it is. So while it might sound like a fine, you know, line, it's actually a very important one. Okay, what type of misstatements are we looking for? We're only looking for material misstatements. Oops. So we are only looking for material misstatements. Things that are immaterial are not our problem. Okay, we're looking for misstatements from either errors or fraud. What's the difference between an error and a fraud?
One is intentional.
Yep. An error. Not intentional, and a fraud is intentional. So a characteristic error is not intentional and a fraud is intentional. And by the way, when you prosecute somebody for fraud, one of the biggest things to prove is their intent, which can be difficult, because they usually don't have nice cut and clear statements saying, I intend to rip off the company or whatever it is. So a characteristic fraud is that it's intentional. By the way, a lot of, if you're saying, okay, well, it still could be error, you know, it could be just someone makes a mistake, or it could be intentional. A lot of times, especially for your larger misstatements, they're going to be frauds, because a lot of times if it was a mistake, somebody would catch it. If someone said they bought a stapler, instead of putting in $6, they put in $6 million, somebody would say, hey, why is there a $6 million stapler in my budget, and complain. And so a lot of times when they do have large misstatements, a lot of times, you know, material misstatements, a lot of times they are fraud. They're done intentionally. Type 1 fraud is financial statement fraud. Oops.
Professor, I have a question. Is your Zoom meetings recorded so we can go back to them?
Yep, yeah. Yes, the Zoom meetings are all recorded. You can go back to them and take a look at them. So if I'm going too fast, and by the way, if I am going too fast, if you ask me, so it's very hard to know how fast people are working. So, but yeah, and if you miss a part, yeah, they're in there. They usually get put up almost always by midnight. I try to get them in there by about 10, but it kind of depends on the videos are recorded and then they are rendered in Zoom, and then I have to go in with an editing software and edit the front ends of them, and sometimes in the middle too. But anyway, so that's another rendering, and then they get submitted into YouTube. And the reason I use YouTube is they have a really good closed captioning, which we need for the ADA, the American Disabilities Act. They have to have closed captioning. So that's the reason why it takes some time to get it in there. And loading, I don't know if you guys ever load stuff into YouTube, but sometimes it's up in 5 minutes, sometimes it's 3 hours. It's kind of hard to predict sometimes. But yes, to answer your question, yes, they are recorded. There's a little bit of a lag, but yeah. Okay, so oops. Fraud 2 is the hilarious understated asset misappropriation of assets. Which is really just employee theft. So employee theft. And as financial statement auditors, which one of these two are we probably most concerned with? Type 1 or type 2?
I would say type 2.
Actually, usually it's type 1. And the reason being is that, especially for larger companies, it would be very hard for someone to steal enough from Walmart to be material. Now, they do have people that, I'm sure they have, employee theft is quite a bit, but there is no one event that's going to be immaterial in it by itself usually. You'd have to steal well over $50 million or whatever from Walmart to be material. So for just your larger companies, it's usually financial statement fraud that you're more akin to. And also because this is what we make we report on the financial statements. That's the only thing we report on. So yeah, usually this is it. Is it possible? Yeah, it's absolutely possible. Someone could be stealing a material amount from the company. Okay. Well, the question comes up, what kind of opinions do you give for, on the financial statements? Okay, the one that's the best to get, and that almost everyone does get, the unmodified opinion, sometimes called the unqualified. Or a clean opinion. Standard report. Those all mean the same thing. Oops. And unmodified opinion is a clean opinion, and it says that the financial statements are fairly presented. And that they are free of material misstatements. Now, that is I should say, reasonable assurance that they're free of it. Oops. I just made up a new word. So fairly presented and free of material misstatements. And that's the best opinion you get. And virtually all companies get that. And I'll tell you why in a second. The second type of opinion is a qualified opinion. Often called an except for opinion. This is when a material misstatement has been found Okay, material misstatement has been identified so we found a material misstatement, but let me reword this. But the overall financial statements are fairly presented. So this is that the financial statements are misstated, but it's usually one or two accounts. But and another terminology thing that they say is that they are not it is not pervasive. In other words, it doesn't go throughout the financial statements. And they call these except for because of the wording. Because they say everything is fine except for, and then they give the bad stuff. So a qualified opinion is, the qualification is except for. So it says everything's fine except for, here comes a qualification, ending inventory could not be verified, or whatever it is. And it is not pervasive through the financial statements. In other words, it doesn't go entirely through the financial statements and make them unreliable. Okay. The worst opinion is the adverse opinion. Financial statements are materially misstated. They're unreliable. Oops. And it's pervasive. Not gap. So adverse opinion is the worst one. You're saying, look, these financial statements cannot be relied upon. For both the qualified and adverse, dollar amounts will be given. Now, so adverse opinion is says you can't rely on these. It's the worst opinion. It means that these are completely unreliable, and you shouldn't look at them. They don't, they're not gap. The dollar amounts are given for each of these because these are known. It's known. The reason for those two opinions is really to try to get management to make corrections to the financial statements. If you tell them, look, you're going to get a qualified opinion or an adverse opinion, hopefully they'll be smart enough to make the changes to the financial statements. Because if they don't, if they get an adverse opinion, it's even worse than having bad looking financial statements because it looks like there's an intent to defraud. So it doesn't do a company really any good to have either a qualified or adverse opinion. And hopefully they'll see the light and say, okay, we'll make the correction. We may not like it, but we'll make the correction that you have suggested here. So qualified opinions and adverse opinions are pretty rare because they don't do the company any good. And the dollar amounts are going to be there anyways. So we say, okay, this $2 million of sales doesn't exist. Or the sales are overstated by $2 million, whatever it is. It's going to be right there. So people reading the report will know that the financial statements are misstated. So that really doesn't do a company any good. Now, do they happen? Yeah, they happen sometimes. You get people pounding on tables. I'm not going to change that. Yes, you are. And then the adverse opinion comes, and that's just the way it is. But it really doesn't do anyone any good to get an adverse opinion or even a qualified. So a lot of times they will make the suggestions to make the financial statements fairly presented. Okay, disclaimer. Freedom of opinion. Freedom of opinion is when the CPA firm is unable yet enough evidence to form an opinion. All right. So disclaimer of an opinion. Somebody just called it a disclaimer. It's when you can't get enough evidence to make it an opinion. So a disclaimer, you can't you can't get enough evidence to form an opinion. For instance, if you go to a client and someone broke in and stole all their computers and all their accounting computers are gone. You know, their entire all their computers are gone. And you say, okay, well, did you have backups? They said, yeah, we have backups. Where are the backups? Kept in the safe. By the way, they took the safe too. Okay, well, you don't have that evidence that you need to form an opinion. So it can occur through a number of different ways, but it's either way though. It's if you cannot get enough evidence to form an opinion. Okay. Let's go to number 3. Number 3 is actually a tough one. Auditors were unable to verify significant investments made by their client. Which audit report would be appropriate for this scenario?
B, qualified report.
One more time.
B.
It could be B, certainly. That's not a bad one.
Is D.
It could be D also. Those two are probably the two.
Okay.
And here's the tricky word in that, significant, because and I didn't tell you guys this, I should have. Significant is less than material, but it could still be that there's enough in there that you question whether it's it's there or not. So it could be that you could give them a modified report saying, look, we can't verify these investments. Or you could say, look, we can't verify these investments, and so we don't know what it is, whether they are real or not. And it could be enough that you give them a disclaimer. So I'd say that one would be, you guys actually did pick the two that were the most likely. Okay. Auditors determined that cash, inventory, and revenues were all materially misstated. Which of the following report would be appropriate?
B, modified qualified reports.
This is probably a little bit more.
Okay, so we can raise it like to modified adverse report.
Probably, yeah. I would say that's probably going to be a adverse report, especially for things like, and we didn't talk about this either. Things like cash. If they have materially misstated cash, that's kind of a big thing. And actually, this is going to be the chapter we're covering. Hopefully, after this. Okay, number 5. I determined that cash, inventory, and revenues were all immaterially misstated. So they're misstated, but it's immaterial.
I would go with A, unmodified.
Yep, that's it. And again, we never say that the financial statements are accurate or correct or anything like that. We say they're free of material misstatements. So if they're immaterially misstated, we may not be thrilled about it, but it's they still get a clean report. Auditors were unable to verify a material amount of offsite inventory on the client's books. None of the other accounts were materially misstated. Which audit report would be appropriate?
B.
Yep. Yeah, so it's isolated to one account, basically. Yeah, so it would be. And why are qualified and adverse opinions rare?
Would it be A?
Actually, it's B.
B?
E.
Yeah. Adverse variance include the misstatement. So because they have no dollar amounts. So if it's going to be in there anyways, if you're telling the client, look, you gotta, you gotta make a $2 million adjustment to your revenues. And you tell them right off, flat right out, well, if you don't, we're putting it in the audit report. A lot of times they'll see the light, and that's what you hope. You hope that they change the financial statements to be so that you give a unqualified or unmodified report. And for companies that are publicly traded, if they were to get an adverse opinion, say, the SEC would immediately stop trading on their stock. It'd be a death knell for them, just Okay, well, that finishes that. We could take a break, but you can actually put that into Blackboard in the ooh, it's a little too big. In the assignments, so you can submit that here. Oops. Let's be back at what time? We'll take a break here. What time is it? All right, we'll say be back at how about 7:13?
Yeah, sounds good.
Okay. Okay, tell you what, pull up the chapter 10 handout if you would. Yeah, check one thing here. All right, so this is kind of a going over auditing. We basically have 5 different types of accounts. We have revenues and expenses, assets, liabilities, and equity. So which of the type is which type of account is easiest to prove?
I would say income statement, revenue and expenses.
Actually, it's gonna be assets.
Okay.
And I'll tell you why, because now, yeah, you can see revenues and expenses, you can see money coming in, money going out.
Mhm.
But the actual proving of it is probably gonna be more aligned with the assets, because assets are tangible. You
Yep.
know, or most of them are, and the ones that aren't, things like cash, you can get bank statements and things like that. So, for instance, if a company says that they have a piece of equipment, that if they, we have a drill press, you can go look at the drill press. When you walk into, say, Walmart, you'll see their inventory, you'll see their shelving, you'll see their store and parking lot and all that kind of stuff. You don't see, say, their utility bill. You don't see their liabilities. You don't see those other things. So assets are usually the easiest thing to prove. So a lot of times they'll start out with, when you're doing an audit, you'll start out with the assets. And usually then next place to go is to the liabilities. Now notice that if you prove out the assets and you prove out the liabilities, by default, that means you must have proved the equity, right?
Yeah,
You
that's
know,
right.
these two have to equal. So if you prove these two, then you know what this one is. If you know what this one is, you'll know what at least the total net income is for the income statement, because the income statement feeds into the equity section. So we really beat up the balance sheet a lot of times when we do auditing. We start out with the assets and then go on to the liabilities. And that, if we can prove those two, most of this other stuff falls in line.
So, so Professor, my question here, auditors will focus only on balance sheet, and by default, they will approve the income statement and the statement of cash flow.
Correct.
Okay, thank you.
Yeah, and actually, I'll do this down here too. We'll talk. We'll go a little bit more in depth on this down here.
Okay.
Okay, the audit of cash. Oops. Hold on. The dollar amount in the cash account is often non-material. You know, so it's often that you'll have a cash account that the dollar amount is not material. If it was any other account, you may even ignore it. However, that's not how you spell however. However, Okay. The dollar amount of cash is often not material. However, almost all transactions go through the cash account. It's almost difficult to come up with a transaction that would not go through the cash account at some point. I mean, you know, the only thing I can think of is if someone donated land for stock or something like that. But almost all transactions will go through the cash account. Okay, so well, let's take so the cash account, when you make a sale for cash, it goes into the cash account, right? So you can make this a little thicker. So by looking at the cash sales, you can verify at least part of the revenues. Now you say, okay, sometimes we don't make sales for cash, sometimes we make it on account, which is true. But notice that those accounts receivable will eventually turn into cash. And the same thing for expenses. You know, expenses will go through cash. It's possible they take kind of the long way around. That they go, this is gonna look like a mess. I don't know what I'm doing here. It's possible to go to accounts payable. And from accounts payable, they run through cash. Memorize this for the test, by the way. Now, so anyway, virtually everything goes through cash. It's hard to come up with something that doesn't. You know, inventory is going to go through cash, maybe go through accounts payable first, dividends will go through cash. You know, all these things will go through the cash account. So one of the reasons why we really beat up the cash account is because we can prove so many other accounts doing it. And even though the cash account itself may not be material, it often proves very material accounts, especially things like revenues and expenses. Revenues and expenses are just kind of counters. It's counting how much money comes in and counting how much money goes out. And so, and then a lot of times they're very large numbers. So the cash account will, if you know, doing an audit of the cash account is often one of the best ways to do it. Another thing about the cash account is often the cash account can be audited at 100%. In other words, a lot of times you can take the entire cash account and audit it. You can look at every single thing that goes into it, every single thing that goes out of it. And this is different than some other accounts. For instance, you know, you could, if you're auditing Walmart, now Walmart, I'm sure, has thousands of cash accounts, but you can get bank statements for those thousands of cash accounts. You know, you can do it. You can get the bank statements for them. And as auditors, we'll get those bank statements sent directly to us from the bank to the auditor. So the client, it'll skip going to the client, it goes directly to us, good evidence. And you can actually do it. smaller companies, even fewer accounts, you can actually do 100%. Now, you take something like Walmart and say, okay, well, let's audit the inventory at 100% at the end of the year. It would be completely impossible. There's not enough auditors in the world to count all of the inventory at the end of the year for Walmart. So one of the reasons why cash is not only does it affect all the other accounts, but oftentimes you can do it at 100% level. You can literally audit 100% of cash, and that will prove out a lot of the financial statements, the other accounts that are material or more material. So we really beat up the balance sheet when we do the audits. Okay. Segregation of duties. These are duties that must be segregated, sometimes called incompatible duties. Oops. So custody of assets, that's the C. We remember it by CAR, C-A-R. Authorizations. And record keeping. Okay, so let's kind of see what we were talking about here. So custody of assets, for instance, example would be treasury. As custody of cash. So Treasury Department will have custody of cash. Authorizations. Purchasing. Will authorize purchases. So purchasing department will authorize purchases. The Treasury Department won't do that. The purchasing department will. Record keeping. This is us, accountants. And these all have to be segregated. For instance, the Treasury Department. Maybe you say, well, why doesn't the Treasury Department do the record keeping for cash, right? They're the ones that are, moving the cash around and paying bills and all that. Why don't you have the Treasury Department do it? Well, they could make the cash disappear, then use the record keeping to cover it up. And almost always when you find there's a problem with fraud or something like that, a lot of times anyways, it's because these have been mixed. That you have people that are mixing, the custody, authorizations, and record keeping. And for, it kind of goes without saying, but for cash, that is extremely important because cash is extremely desirable, obviously. Everyone can use cash. If you're trying to steal inventory, okay, how many toasters do you need? okay, well, I have to sell the toaster and you know, to get money, cash is just, everybody could use it. So it is a very kind of a desirable and somewhat vulnerable asset. Okay. So here's kind of a walkthrough we'll do about how you receive cash, kind of the normal flow of things for cash. So here we get a check from Joe customer. Ooh, don't do that. Okay, so Joe customer sends us a check, $123.45. So we get the check. And it comes to the mailroom. Or the counting room, depending on what it is. I did this, by the way, when I was going through college. I didn't know at the time that I was part of the process, but I worked in a bank and in doing maintenance and stuff. And anyway, one of the jobs was that I had to go into the mailroom, and with the mail guy, we would go through the checks together. There'd be two of us in there. Then we would go through and list out all the checks that came in, and count them, and we both would put them on a list and that. And I didn't know at the time, but why do you have two people there? Well, why would you have two people there? Why don't you just have one person? I mean, one person could have counted the checks. Why don't you just have one person do it?
Just like for more checks and balance, just to make sure.
Exactly. It's the idea is, okay, is it possible you have somebody who's not trustworthy? Yeah, it's unusual to get two of those people in the same area. And even if you did, there might be that social thing that they're not going to ask the other one to do something illegal because they don't want to, whatever. So yeah. So it goes to the mailroom. And in the mailroom, they will make out two lists. One list they'll send to accounts receivable. The accounts receivable clerk will credit the accounts for whatever on that list. The next list two of the same checks will go to the cashier. And the checks will go there also. Okay, now you might say, well, why don't we give the checks to the accounts receivable person? Why can't the accounts receivable person to get the checks? Well, the accounts receivable person has access to the records. So think about this for a minute. If you're the accounts receivable clerk, let's say you get a check in for $500. All right. Now you have access to the account, so you could actually possibly go in there and write off the account for $500 and keep the check. Right? And then deposit in a bank account that has a similar name to your company. Yeah, so there was actually a secretary that was doing this at a place I worked at. She worked there for, I think it was 48 years or something. I can't remember what it was, but she was there like the longest employee that they ever had. And she'd set up a bank account of a similar name so many years ago that they couldn't find when it was actually originated. And she would actually run company checks through it. But anyway, you don't want to have the accounts receivable person have the custody of the check. That's an asset. It's cash, right? You don't want to have them have that asset and then also have access to the records so that they could cover it up. And think about what would happen if, if they were able to write off the account and they take the check, the customer won't complain because their account is, show that it's taken off. The company wouldn't know that it was gone. It would be, the record would show that it was written off. It didn't show up, even though it did. So, that's one of those reasons why we keep these separated. And by the way, when you do combine them, then you're in for a whole can of worms because it's very difficult a lot of times to unwind those. Okay, so the checks. Hey, where'd it go? I lost something here. Okay, so cashier gets them. Cashier puts them in with the deposit along with the cash for the day and puts it into the bank. And so here's the deposit, and here it is showing up on the bank account, the bank statement. All right, so this is kind of the flow of the company gets a check in. Hey, I did have an extra one here. Now, suppose you wanted to find that check for 12345. Would you find it on the bank statement?
Yeah.
Actually,
Well, like the physical check or the deposit?
the physical check.
No.
So let's say, yeah, if the customer calls up and says, hey, I sent in a check and you're not showing it on my statement. I sent the check for 123, whatever. You would not find it on the bank statement. You have to go to the checklist and the deposit, and hopefully it should be on both of those, right? It should be on both of those.
Awesome.
Now, here's where the checks and balances thing comes in. Suppose it's on the checklist, but it's not on the deposit. Who took the check?
Associate?
Cashier.
Cashier?
Yep, cashier took it. So that's one of those things that you can look at and see if there's a problem. Now, if it's on both of these, it might be the customer's mistaken or something, and you can also go check and see if they actually, the accounts receivable person may have missed it or something and then put it through. But anyway, so this was kind of the usual way that you have the oh, no, say individual checks can be verified in the bank. Right there, you got it. Okay, individual checks. Just what we just talked about. Okay. If an auditor needed to confirm that a customer had submitted a check to the client, which document would the auditor likely examine?
Checklist.
Yep. And by the way, we take the CPA exam looking for the best answer, and checklist would be the best answer. The next best answer would be deposit slip, but notice that because the check may have been stolen or misplaced or whatever, the checklist would be the place that you would want to see if the customer had actually submitted the check. It might have been that the check was lost or taken afterwards and did not show up on the deposit slip. But if you're looking to see if just that the customer had submitted it, then the checklist is the best of those. If a customer cashed a check, the customer's cash check was missing and did not appear on the checklist, who likely misappropriated, stole the check?
Counter room employee.
Yep. That would have been me and the other guy.
By the way, I've done the same thing like when I started like in accounting. So
Oh yeah.
I was collecting like checks, whatever I received in the mail, but I was alone. I don't know why. It didn't.
I'm
Well,
actually doing
in
this
some
now.
places, some places will. Some places, it's not that's so uncommon to have it alone.
Yeah.
I'm actually doing this now.
Oh,
Cashier.
really?
Yeah, at the Alzheimer's Association.
Oh, okay.
Yeah.
I'll tell you, well, this is the really bad part about what I did. The guy that I worked with, that did it, I remember the guy's name. I'm not going to tell him to you, but super nice guy, blah, blah, blah. About, no, like 2 or 3 months after I left, he ended up shooting his wife. I could not believe it. I worked with the guy every day. He was just laughing all the time, joking and all this stuff. And sure, it's the weirdest thing. It's one of those weird, she lived, thankfully, but I mean, what a weird. And you usually don't get that working at a bank. I mean, it's okay. Bonding employees. Bonding, well, if you guys did you guys are probably bonded if you're doing the kind of checks. Oops. Bonding is an insurance policy. I should say covering. Bonding is an insurance policy covering employee theft of cash. So it's an insurance policy, but it is restricted to employee theft of cash. So if employees steal money, that they'll reimburse you up to usually some amount, 1 million, 5 million, whatever it is. So all this is an insurance policy, and it's for usually people that handle cash, cashiers and things like that. Now, it does not replace internal controls. So you say, okay, well, these people are bonded, so you don't have to worry about it. Yeah, you still do. Bonding does not replace internal controls. And the big benefit of bonding is these insurance companies, they do the bonding agents that do the bonding, they do background checks. And this is really kind of the big thing that occurs for the bonding. It isn't so much usually the insurance policy. It's that bonding companies will perform background checks on employees. So bonding is just insurance policy. It does not replace internal controls. It's only for the theft of cash usually. And it's for people that handle cash. So in the accounting room, I think I was bonded when I was at the bank, and anyway. But the bonding companies will perform background checks on employees. And I had a friend who worked at a company where they hired somebody, and I was a good person, blah blah blah. I went through the interviews, went through all the whole department, and then they got back from the bonding company. They said, we're not going to bond them. You can hire them, but we're not going to bond them. Because he had been convicted of fraud a couple of times, and he'd done like 3 years in prison or something. Obviously, that didn't come out in the job interview, but that was the background check. That was kind of why you pay what you're paying for when you do the bonding. Okay. Lockbox services. Lockbox services are basically to get rid of all of this. Lockbox services are when the customer payments are submitted directly to the bank. And the bank will submit the checklist. They call these lockbox systems. Yeah, the reason they call them lockbox systems is that that's people used to would actually take their checks and actually stuff them into a locked box. You know, they obviously, and they don't do that anymore, but they would just take the checks and submit and stuff into the locked box, and that lockbox would be then you know, taken out and stuff counted. But so the customer submitted payments are submitted directly to the bank counts them and sends a checklist to the client telling who paid what, and those checks are automatically deposited into the account. The nice thing about this is the client's employees will never have custody of the assets. They'll never have the checks. So there isn't somebody grabbing the check and running away with it. They never get it in the first place. Okay. Number 3, which of the following are true regarding the lockbox system?
D.
It's a D.
Yep. Yeah, they'll never have access to the customer's checks. You won't need to have them bonded, you know, because fewer people will be handling the cash. There will not be a longer delay. It'll be quicker. They wouldn't have anyone running to the bank. It's already in the bank. Okay. Disbursement of cash. Okay, first thing that we, voucher payable documents, we have purchase orders. Oops. And these are authorizing purchases. And they'll have all kinds of stuff in here. They'll have designated vendors and stuff you can buy. You can't just go in and order a Ferrari or something. You know, they'll have a list of things that are the people are able to order and all that sort of thing. And the purchasing department will work that all out, get the prices and approvals and all that. Okay, once our purchase order is made, then you'll have the receiving report. And this is done by the receiving department. And this will usually could be a purchase order without the quantities listed. So if something comes in, there'll be a receiving report. The receiving report usually matches up with the purchase order, or you know, it should at least anything that comes in should be matched up to a purchase order. It might not have everything that you ordered. It might be things that are back ordered, but the purchase order should match up with it. And usually it's listed without the quantities. why is it listed without the quantities? What do you want the receiving department to do? You order 15 hammers. The hammers come in. And they have this purchase order that doesn't have the quantities listed. What do you want the receiving department to do?
To validate the quantity. Without the quantity, they cannot validate the receiving.
Yeah, do we get all 15 hammers, or did they send 10 or 11 or whatever? You know, that you want them to count it, so you leave that blank. Because if you say there's 15, they might look at that's probably 15 hammers and go on. So generally you have the quantities are blacked out or blanked out so that you can go ahead and make sure that they count those. So the receiving department, so the receiving report will be we'll have the actual count of whatever comes in. And then that gets matched up with the vendor invoice. And the vendor invoice should match the purchase order and receiving report. Now, when I say match the purchase order, that only those things that are on the vendor's invoice should be also on the purchase order. Maybe all of them were shipped, but those things that were shipped should be on the purchase order. And the receiving report should have the right quantity on it. So those things should be also included on the vendor's invoice that, okay, we sent you, we didn't have 15 hammers, we sent you 11 hammers. And here's the bill for 11 hammers. So those things, those three things are all matched up. Once those are all matched up, a couple different ways you could do it. And one way or another, accounts payable will authorize payment. And you have to have all those, the purchaser, sometimes people will just send you stuff and then send you a bill, even though you didn't order it. So, you got to make sure you match up all these things are matched up. The receiving report should be matched up to the purchase order, should be matched up to the invoice. Oops, I guess we don't need that. Question on that? I think I'm gonna stop here. Let's stop here. All right, so not next week, the week after next week. We'll go through and finish this up. This actually is kind of a long. Yeah, right. Like this is one of those handouts I think is gonna. It'll take like a couple. It'll take like an hour and take 6 hours or something. But anyway, so let's stop there. So we'll stop on what page is it? Page 3. So obviously you do not turn this one in. So you can turn that review one in, and then hold off on this one. And so again, next week, let's say week 2. Week 2, no class. Okay. Any questions? About enough of that kind of definition-y stuff. All right, we'll get more into the numbers kind of stuff next week as far as proving out cash and all that. So anyway, not next week, sorry, in 2 weeks, when we come back in 2 weeks, we'll go through a little more interesting stuff. So if you already done it, go ahead and submit that auditing review sheet. And yeah, and I'll see you guys in 2 weeks. All right,
Thank you, Professor.
Yeah.
have a good evening.
Great, thank you.
Thanks.
Good
Good
weekend.
night.
Have a good
Thanks, Professor. Have a good night.
Thanks, Professor. Good luck.
Oh, thank you.
Thank you. Good luck with surgery.
Thanks.